I'm here to give you a light over the Ind AS standards. We'll cover the introduction to Ind AS and its applicability. Then we will cover Ind AS 16, Ind AS 38, and Ind AS 40. These are all asset-related standards. Once we cover all the standards, you will have a grip over what is Ind AS and how it is applicable to all the asset-related standards. And wherever you have any questions, just let me know. At the end of the seminar, we will discuss all of your questions. So, beginning with the applicability of Ind AS. As you all know, on 16 February 2015, the MCA issued a notification wherein Ind AS was applicable in a phased manner. What were the phases for such application? The application or implementation of Ind AS in India was divided into two main phases. Phase 1 was for such kind of companies whose net worth is above 500 crores. These companies would be listed, unlisted, or in the process of listing. But whosoever net worth is above 500 crores was in the phase 1. This phase 1 was for such companies whose first Ind AS financial statements had to be published on 2016-17. So in India, the first Ind AS financial statements were published on 31st March 2017 for the entire financial year 2016-17. Then the second phase, phase 2 was for such kind of companies which are all listed companies were covered under phase 2. Irrespective of your net worth criteria, you have to apply Ind AS if you are a listed company. Or if your net worth is above 250 crores, then you fall under the phase 2. That is, your first Ind AS financial statements are to be published on 2017-18 for the financial year 2017-18. But now you will tell that we have also heard of IFRS. So how is IFRS different from Ind AS? India has adopted IFRS, which is 90% similar to IFRS, with certain changes to the Indian scenario. So these are called as converged IFRS. Ind AS is converged IFRS with certain differences to the Indian scenarios. All IFRS are as it is applicable to India. So Ind AS is nothing but 90 to 95% of IFRS with very minimal differences. Over a period of time, government is also trying to resolve or minimize these differences by amending the standards on period basis. Now, you would say 31st March 17 is also over, 31st March 18 is also over. What ahead? Whenever a company falls subsequently, that is, net worth of the company increases by 250 crores in a subsequent period, then from the immediately next financial year, Ind AS would be applicable for that company. What does that mean? So if a company has its on 31st March 2018 or 31st March 2019, if the net worth of the company is say 270 crores, then immediately the company has to publish Ind AS financial statements on 31st March 2020. So you have to apply Ind AS from the immediately next year basis if your net worth is increasing the specified criteria. Now, are only these companies covered under Ind AS? No. Any companies which are linked in sense subsidiaries, joint ventures, associates, holding company, the entire group is covered under Ind AS. So if one company is getting, if the Ind AS criteria or the net worth criteria is getting met for one company, all the aligned or all the synced companies are also covered under the Ind AS regime. So, and one more option was that was previously said that the companies could also apply Ind AS voluntarily. So even if you're not fitting into the mandatory criteria, that is, even if your Ind AS or your net worth is not getting reached 250 or 500 crores or you're not a listed company, still Ind AS would be applicable to you. You can voluntarily apply Ind AS on a voluntary basis. No need of this mandatory criteria. So this is the third criteria. For all these set of companies, Ind AS is applicable. Now, what is the key pointers or key takeaways from this applicability? Once Ind AS is applicable to a particular company, it is applicable forever. So if you be into the mandatory criteria or you be into the voluntary criteria, once you select application of Ind AS, you cannot go out back to the Indian GAAP. You have to apply Ind AS hereinafter forever. There is no going back from this application of Ind AS. Then what next? For example, if a company was your subsidiary as on 31st March 2015, then in 31st March 2016, it was not your subsidiary. Then what? Doesn't make a difference. If once the Ind AS was applicable to the subsidiary also have to apply Ind AS for all its subsequent financial statements, irrespective of whether it is a subsidiary in the later phase or not. Doesn't make a difference. Second question. My net worth criteria is 250 crores or 260 crores right now. In the next year, I incur certain losses, and again I'm back to the below net worth regime. Again, doesn't make a difference. Once Ind AS is applicable to you, you will have to apply the Ind AS. Third question, I would cover this in the later sessions also, but there is difference between what is a subsidiary under Indian GAAP and what is a subsidiary under Ind AS. So if a particular company doesn't meet or wasn't meeting the definitions of subsidiary under Indian GAAP, but due to the detailed criteria of Ind AS, the company is meeting the criteria of being a subsidiary. So what? The Ind AS is applicable to that subsidiary also. So you have to apply the Ind AS principles to determine whether a company is a holding company or a subsidiary company or an associate company or a joint venture company. If the criteria are getting met, then the Ind AS is applicable to those companies also. So we'll cover that under Ind AS 110, but Ind AS 110 provides more detailed criteria under which a larger bandwidth is provided for determining whether a company is a subsidiary or associate or joint venture or not. So in this manner, Ind AS is applicable to various companies. The applicability of Ind AS through a net worth criteria is simpler. It is easier to determine whether a company is about 250 crores or 500 crores. But we have ourselves seen many companies who have missed on to application of Ind AS because they were not into, so we had one of the associate whose holding company was into Ind AS, but that associate company wasn't aware that holding company is into Ind AS. And that is why they skipped on to application of the Ind AS. So in this linked scenario, where the Ind AS is applicable to holding subsidiaries, associates, and joint ventures, it is very important to identify which all companies are getting covered into the region and which are not getting covered into the region. So for the corporates, the roadmap was 31st March 2016-17 and 2017-18, phase 1 and phase 2. Similarly, for NBFCs, the phase 1 and phase 2 criteria was similar. Just for the phase 1 companies, the first financial year was 2018-19. All the criteria were same, 500 crores net worth and everything was same. And phase 2 was 2019-20. So there was certain time gap between which the NBFCs also came into the region. So as of today, the normal corporates and NBFCs are into the Ind AS region. The Ind AS was also applicable to banks and insurance companies, but it got deferred due to various criteria. Various clarifications were required to make the Ind AS applicable to banks and insurance companies. So as of today, application of Ind AS to banks and insurance companies have been deferred. Okay, so let's move ahead to once it is determined that Ind AS is applicable to particular companies, what next? How to apply Ind AS for such companies, how to converge from your Indian GAAP, that is your previous GAAP, to Ind AS. How will you disclose financial statements, whether you will apply the Ind AS prospectively, retrospectively, how will you give effects to your financial statements, which kind of disclosures are required, whether the comparatives are required to be restated or not, what are these criteria and how you should shift from your Indian GAAP to Ind AS is what we would discuss next. So, for example, if a company is into the Ind AS regime, which was into the phase 1 company, so we'll just discuss that as an example. So your first year of financial statements, that is the first year was 2016-17, was your first year in which Ind AS is applicable. So your first complete set of financial statements under Ind AS have to be published as on 31st March 2017. But what all restatements are required? You will have to give a comparative year, that is 15-16. So the comparative year also have to be under Ind AS, and you also have to give an opening balance sheet as on 1st April 2015. So as on 31st March 2017, there would be 3 set of balance sheet, or there would be 3 columns in your balance sheet: 31st March 17, 31st March 16, and 1st April 15. Why 1st April 15? because balance sheet is as on date. To give the impacts of the Ind AS, to give the impacts from transition to Indian GAAP to Ind AS, one particular date or one particular point in time is required. So as on 1st April 15, that is your transition date to Ind AS, you will have to give all the impacts to your balance sheet. Once you have given all the impacts to your balance sheet, your entire 15-16 comes under Ind AS. Your entire 16-17, which is your live year under Ind AS, comes into the Ind AS fundamentals. So now you have 3 columns into a balance sheet and 2 columns for your P&L. So your P&L would be 16-17 with comparative of 15-16 with opening balance sheet date of 1st April 2015. Now for listed companies. For listed companies, their first Ind AS which came into the public forum was as on 30th June 2016. That was the first quarterly financial statements which came under the Ind AS. So over there, they had to give the first quarter and all the interim quarters under the Ind AS scenario, and then at the end, they had to give the entire complete financial statements under Ind AS. So this is how the entire convergence from Indian GAAP to Ind AS has to be made by giving the date of publishing or what all kind of columns or what all kind of financial statements have to be published under Ind AS. We will move to the next slide. Now, as we know under Indian GAAP, there are 2 to 3 set of components of your financial statements. Under Indian GAAP, you had balance sheet, you had statement of profit and loss, statement of cash flows, and notes to your financial statements. These were the only 4 components of your financial statements. Whereas under Ind AS, you have these all components. First is the balance sheet. Second is statement of profit and loss and other comprehensive income. So what is other comprehensive income? That also we'll discuss. Statement of changes in equity, which is also a new statement under Ind AS. Notes to the financial statements, equity and profit reconciliation for first time adopters. So these are the 3 things which are new under the Ind AS regime. So we'll discuss this one by one. Balance sheet is same as we have it under any GAAP. Statement of profit and loss is same. Other comprehensive income. Now there are various components for which your routine profit and loss or your normal profit and loss should not get impacted. These kind of items have been listed under the Ind AS. Only such selective items have to be published or have to be disclosed under other comprehensive income. Other comprehensive income is nothing but just a statement. So they are provided certain line items. I'll give you an example. For example, I'm a company, I have invested into various companies, I have my investments. But my purpose of those investments is not to trade on day-to-day basis. So the basic fundamental under Ind AS is every investment have to be fair valued. Now, if every investment have to be fair valued, why should this fair valuation gain or loss should impact my P&L? Is my purpose trading into these investments? Is my purpose to gain routine or daily profits into these investments? No, I have invested in these investments for a long-term basis. I am not holding these investments for trading. So such kind of investments or gain or loss on such kind of investments are to be routed through other comprehensive income. So when you pass the accounting entry for such kind of investments, you record the gain under the investments, so investment account debit. You directly credit a reserve, that is gain on the fair valuation of investments. For example, there is a gain of 100 crores. So while passing the accounting entry, you have passed the accounting entry as investment account to fair valuation gain on the investments. But this 100 crores have to be routed or have to be published in the account other comprehensive income, have to be disclosed in other comprehensive income. So other comprehensive income is not an account. It is just a statement to disclose certain items which are provided under Ind AS, which are of specialized nature and which should not affect your routine profit and loss. So we will discuss what items are covered under other comprehensive income in detailed manner, but just to give you a concept of what is other comprehensive income. It is just a statement to give you the details of certain specified transactions. Then next, moving on to the next statement. What is statement of changes in equity? As the name suggests, Statement of changes in equity is nothing but a statement which shows your movement between the equity. It includes equity share capital as well as reserves and surplus. So, equity share capital, as you give it into your notes to the financial statements, you show the movement in the equity, opening equity, add additions, less any kind of buyback or any kind of deletions, and a closing balance. So, this is your movement in the equity or equity share capital, preference share capital, any kind of capital. Second is your reserves and surplus. Any kind of reserves, you show movement of those reserves in this statement of changes in equity. You show all the movement, whatever has happened into this reserves into this statement of changes in equity. Anything which forms a part of equity, for example, minority interest, or also called as non-controlling interest under Ind AS, is also disclosed under this statement of changes in equity, and movement in this non-controlling interest is also disclosed in the statement of changes in equity. Or you have share application money pending allotment, which also forms a part of equity. The movement of this share application money pending allotment is also disclosed in this statement of changes in equity. Then next, cash flow statement is same into what we discussed under the previous gap. It is similar, no changes. Whatever are the changes between the gap that we will discuss in the respective standard. Then next, notes to the financial statements. So for the purpose of notes to the financial statements, you will have to see what each standard provides for the purpose of disclosure and what the Schedule 3 provides. Now Schedule 3 for the Ind AS companies and for the Indian GAAP companies is different. So Division 2 to the Schedule 3 is for the Ind AS companies and Division 3 is for the NBFC companies. So Division 2 is for the corporates or non-NBFC companies and Division 3 is for the NBFC companies. So whatever disclosure requirements are there either under the Schedule 3 or under the respective standards have to be disclosed in the notes to the financial statements. I'm discussing this so that you know what are the sources of information, where to look into. So I'm just telling you what are the sources. There is also a guidance note on the Division 2 under Ind AS. So that will also give you a clarification on what or how which kind of disclosures are required under Ind AS. Okay, so moving on to the next slide, what we would discuss is what and how to account the impact as a result of the Ind AS adjustments. Now, as you all know, the accounting policies or the way of recording particular transactions is different under Indian GAAP and under Ind AS. So when there is a difference between Indian GAAP and under Ind AS, obviously there will be certain transactions or events which have arose before the date of transaction. So by default or by a general rule, remember one thing, any particular change in the accounting standard or the GAAP as a whole has to be applied retrospectively. If it has to be applied retrospectively, then you will have to recognize all the assets and liabilities which were required under Ind AS. So if a particular asset was not required under Indian GAAP but required under Ind AS, you will obviously have to recognize it. You will have to de-recognize such assets and liabilities which are not required under Ind AS. You will have to regroup if particular item or if particular event or transaction has to be disclosed in a particular manner under Ind AS. You will have to regroup such items and you have to remeasure also. So there are four main changes: recognize, de-recognize, regroup and remeasure is what all changes you require to move from Indian GAAP to Ind AS. If you list down all these changes required for your particular company, it is very easy for you to converge from Indian GAAP to Ind AS. It is not a big thing. It will be very simple for you if you categorize all your differences in this form. Now, if you identify such differences, what will you do of the resulting adjustments? अगर एक item was measured at 100 crores in particular in Indian GAAP, now you measure it at 120 crores under Ind AS. What to do of this 20 crores? This 20 crores has to be adjusted in your opening balance sheet. We discussed previously the opening balance sheet. So as per our previous example, these adjustments have to be recognized as on 1st April 2015. So, continuing with my previous example, for example, investments were not required to be fair valued under Indian GAAP, but under Ind AS, you will have to fair value those investments. Though the gain of 20 crores, what will you do of the same? So you will debit the investments account by 20 crores and you will transfer that gain to your retained earnings as on the date of transition. That is, for example, 1st April 2015, and your balance sheet as on 2015 will appear inflated into investments by 20 crores and retained earnings by 20 crores. So whichever items, as per the respective recognition criteria, whichever items have to be transferred under retained earnings, you transfer under retained earnings. Or if there is any other appropriate reserve, for example, ESOP reserve, fair value of equity investments, what we discussed previously, such reserve, any other appropriate reserve as per the respective accounting standards. You don't have discretion. You have to refer the appropriate standard to determine which appropriate portion of equity has to be debited or credited for recording these Ind AS adjustments. Okay. Now, this is for all the items which have to be recognized mandatorily under Ind AS. So, as I said, as a general rule, retrospectively, all adjustments, whatever is the difference between the Ind AS and the Indian GAAP, has to be mandatorily recognized. But there are certain exemptions and exceptions. What do you mean by this? Ind AS 101, transition to first time adoption of Ind AS, this standard has provided certain exception to this general rule. So our general rule is mandatory retrospective adoption. So an exception to this general rule are mandatory exceptions as per Ind AS 101. What do you mean by this? Mandatorily, you don't have to record for these exceptions. So even if there is a difference, the accounting standard also knows that there is a difference between Indian GAAP and Ind AS. But the Ind AS 101 has mandatorily provided that you don't have to record for this differences. This is mandatory in nature and you don't have any option. And second, and these are the set of list. So you will be provided with a list which have mandatory exceptions. That mandatorily this is not allowed. And second is the optional exemption. What do you mean by optional exemptions? You have an option whether you want to go with this exemption or not. So, for example, if there is a difference between two particular standards, so on your own you can account for that difference. But if you want, there is an option of not accounting for such difference and continuing as it is as per your previous amounts or previous GAAP amounts. So this is optional in nature and this is mandatory in nature. So you will have to refer Ind AS 101. We will also cover standard by standard basis what are the mandatory exceptions and what are the optional exemptions. But I'm just giving you a source which provides the mandatory and optional exemptions. If you have any queries till now, you can note it down and we will discuss it at the end of the lecture also. Now, this was all about the Ind AS, how it is applicable, to whom it is applicable, and how to give impacts of Ind AS. So this is just to give you a broader picture about how you need to transit from your Indian GAAP to the Ind AS accounting standards. Now, there are a list of standards which are covered under the Ind AS. There are certain standards which were previously not at all there in your previous Indian GAAP, but there is a complete set of standard under Ind AS. One of which we are going to discuss today is Ind AS 40, investment property. There was no detailed standard under Indian GAAP for this particular transactions, but there is a standard over here. Various such transactions are non-current assets held for sale and discontinued operations, Ind AS 105, which is also a standard which was not there under Indian GAAP. Then there is a detailed guidance on financial instruments, which is one of the critical and the most important standard under Ind AS, and which has majority of concepts, a bit difficult concepts also I would say, but very important if you need to understand Ind AS financial statements. Then you have deferred tax, which you also, we had deferred tax also, but we have a detailed guidance under Ind AS on deferred taxes. You have revenue recognition, Ind AS 115, which has been recently amended from Ind AS 11 and 17. So revenue also, if you look into the Ind AS, the principles are same, but the detailed guidance or the variety of transactions which are covered under Ind AS for which the guidance is provided is you don't, the Ind AS does not leave you with choices. People cannot follow different accounting policies because there is lack of guidance. Then one of the important standard also is the consolidation and the business combinations. So these are the 4 critical standards under Ind AS, and other are there with certain differences. So today we will cover Ind AS 16, that is property, plant and equipment. Ind AS 38, that is intangible assets, and Ind AS 40, that is investment properties. By this, we will be able to cover the major asset related standards. So we'll go one by one.